The S&P 500 is currently trading right at its all-time high, and along with this, we're seeing many quality dividend growth companies continue to increase the amount they pay out in dividends. So in this video, we're going to be looking at 5 different dividend stocks that just recently announced dividend increases, and one of these companies I actually own in my personal portfolio. To analyze these stocks, we'll be using my spreadsheets from tickerdata.com and the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. Now let's go ahead and jump in. The first dividend hike we're going to look at is going to be one that I own in my personal portfolio, and that is Altria, and they just announced a dividend increase of around 4.1%. I'm pretty happy with this dividend increase, and the main reason is this is a very high yielding dividend stock. Now, I don't own many high yielding dividend stocks in my portfolio, but again, this actually is one that I own in my personal portfolio. And actually, if we blow up my growth chart, I've done pretty well with this Altria position. You can see as of right now, I'm currently up around 33%. If we jump over to my dividend dashboard, we can see over here, this position is currently paying me around $350 every year, but this amount is about to increase by about 4.1% because of that recent dividend increase. Now, if we look at them over the past year, they're up around 22.61%, and year to date, currently up exactly 30%. If we jump over to my dividend breakdown sheet, we'll come up here and plug in MO, and we can see all this data will automatically load in. Now, this is a very recent dividend hike, so this isn't reflected on the dividend sheet yet, but the dividend payout after this dividend increase is going to be closer to around $4.08, and that's going to put their starting dividend yield a little bit closer to around 8%. And we can see this company has a very nice history of dividend increases. In fact, they're a dividend king with over 50 consecutive years of dividend increases. And look at that 10-year dividend CAGR. It's sitting at about 7%. Which is actually really impressive when you consider the fact that this is a very high yielding stock. So a nice combination of high starting dividend yield and high dividend growth over the past decade. Now, it has slowed down a little bit over the past 5 years, closer to about 3.6%, but again, this most recent dividend hike was a solid one at about 4.1%. Now, the main concern a lot of people have when it comes to Altria is how sustainable are those dividend payouts. They do have high payout ratios. Payout ratio is looking at about 83.38%, and the free cash flow payout ratio at about 74.57%. And if we look at the free cash flow payout ratio over time, we can see it's remained pretty high for quite some time now. So is this something to be concerned about? And this is where we have to understand the role of management in deciding capital allocation. There's 5 different things they can do with free cash flow. They can reinvest back into the business, they can buy back shares, pay down debt, or attempt mergers and acquisitions, or pay out dividends. And what the management team at Altria has decided is that one of the best ways to reward their shareholders is by paying out dividends. And actually, we can see they've talked about this. We can see they're actually targeting a dividend payout ratio of about 80% of adjusted diluted earnings per share. So this high payout ratio isn't by chance, it's not by accident. This is actually what management is intending. And if we look since 2018, we can see free cash flow has been covering those dividend payments, which is exactly what we want to see. And if we jump over to the stock screener sheet, come up here and plug in MO, and one of the things I do want to point out about Altria, yes, they are buying back some shares, but the return on invested capital is actually really good for this company. And this catches a lot of people by surprise because typically you only see really high quality tech stocks with high levels of return on invested capital. Think of companies like Visa or Microsoft. But Altria had a return on invested capital in 2023 of 39.27%. Look at this in 2022, 29.31%. This is typically something you see with really high quality companies, so this is a good sign for Altria. Our next dividend increase is Republic Services, and they announced a quarterly dividend increase of around 8.4%, so that's a pretty solid starting dividend yield. And if you're not familiar with this company, they're very similar to Waste Management. We can see over the past year, they're up around 41%, and if we look at them year to date, now up 25%. So they've been on a pretty good run as of late. If we jump over to our dividend breakdown sheet, let's go ahead and come up here and plug in RSG. And we can see, yes, this is a company with a lower starting dividend yield, but the 5-year dividend growth rate is now sitting at about 8.26%, which, like we just saw, is actually right at around where that most recent dividend increase was at about 8.4%. So we can see they're now paying out about 58 cents per share quarterly. And if we jump over to the dividend breakdown sheet, again, history of dividend increases, and the free cash flow is growing at a very healthy rate, easily covering those dividend increases. And here's what I really like to see out of dividend growth stocks: when the free cash flow payout ratio is decreasing over time. So yes, they're still increasing those dividend payments, but the free cash flow payout ratio is actually decreasing because free cash flow is growing at a rate even faster than the dividend payments. This is something I really like. Our next stock is a company that probably just had the largest dividend increase that you're going to see all year, and that's Coca-Cola Consolidated. Now, don't get this confused with stock ticker KO. This is a completely different company. This is the bottling company for Coca-Cola, and we can see they just announced a 400% increase to their dividend payment. Now, when you see an increase of around 400%, at first glance that's exciting, but we have to ask ourselves, is that a sustainable dividend increase? Because if their free cash flow can't back that dividend payment, then this is actually bad news for the company. So let's dig into this. Now, first off, if we go over to Seeking Alpha, we can see the company's done really well over the past year, up 99.23% in the past 5 years, now up around 289%. So pretty impressive. And if we jump over to our dividend breakdown sheet, we'll go ahead and come up here and plug in Coke. And this data will load in, and we can see the starting dividend yield low sitting at about 0.74%. That most recent dividend increase, again, was 400%. But what we can see is free cash flow has been growing at an extremely fast pace. Look at this. 2017, the company generated around $131 million in free cash flow. And then look at them in 2023. $528 million. That's a massive increase. We can see a 5-year free cash flow CAGR of 76.73%. 10-year of 31.21%, and at the end of 2023, their free cash flow payout ratio was only 8.87%. So this 400% increase in dividend payouts really isn't anything to be concerned about. I think this is completely good news. This is very sustainable for the company. And we have to keep in mind, after this most recent dividend increase, one of the things we can see is the starting dividend yield has now been bumped up closer to about 1.92%, which is much more attractive if you're interested in receiving dividends. Now, one of the things we do have to take note of is this company hasn't historically increased its dividend payouts in a very long time. In 2023, they actually paid out a special dividend, which is the reason we see this bump here. But perhaps moving forward, this is a sign they plan on increasing their dividend payouts as their free cash flow grows. And then our fourth dividend increase is not a good one. This is Clorox, and they just announced a 1.7% dividend increase. Okay, now before we look at anything else, one of the things I always have to make note of, anytime you see a dividend increase that is below the rate of inflation, that company is technically paying out less in dividends. So while on paper, yes, they did increase their dividend payouts, it didn't keep up with inflation, so they're technically paying out less. Something to keep in mind. Now, if we jump over to Seeking Alpha, we can see over the past year, traded pretty flat, up around 1.38%, but pretty bad compared to that of the market, which is up pretty big this year. If we look at the past 5 years, they've way underperformed. They're actually down 1.84%. Now, if we go ahead and jump over to the dividend breakdown, we'll come up here and plug in CLX, and we can see this company has a decent starting dividend yield. It's sitting at about 3.2%. And as of the end of 2023, the payout ratio looks unsustainable. It looks a little bit crazy, but keep in mind, we want to focus more on the free cash flow payout ratio. Earnings can be manipulated by accounting practices, but the free cash flow payout ratio isn't going to lie to us, which is why it's so important to pay attention to this metric. So we can see the free cash flow has been covering those dividends for the past decade, a little bit of a slip up in 2022 when free cash flow was down by quite a bit, but overall, free cash flow is covering those dividend payments. We can see a 10-year dividend CAGR of about 5.34% and a 5-year closer to about 4%. But free cash flow really isn't growing at a very high rate. We can see that 5-year free cash flow CAGR at just about 3.6%. So with free cash flow recently kind of fluctuating up and down and definitely not growing at a very high rate, it's easy to see why they're concerned about increasing their dividend payments at a high rate. They don't know if that's sustainable. And if we jump over to our stock screener and plug in CLX, what we'll see is there really hasn't been a lot of growth on the top and bottom lines. Look at the past decade of revenue per share, sitting at about $43 per share in 2013 to 2023, about $59.80. So yes, it has grown, but not at a very high rate. Free cash flow per share has kind of been all over the place, but overall it has grown, but again, not at a high rate. We can see earnings per share has actually plummeted over the past few years. And then if we jump over to the profitability sheet and plug in CLX, what we'll see is revenue growth has been pretty slow over the past decade, just 2.7%, and the 5-year revenue CAGR just 3.8%, and to make matters worse, the gross profit ratio has actually been declining a little bit over the past couple of years. So there's a lot this company needs to clean up to get back on the right track. And then finally, our fifth company is McKesson, stock ticker MCK, and they just announced a 15% dividend increase. That's a really good one. This is a healthcare company and a drug distributor, and you can see they're currently trading at $552.15. In the past year, overall has been good, up around 31.06%, and if we look at them year to date, currently up around 19%. Now, if you're paying attention to this chart, you can see it looks like there's a huge sell-off in early August. So what was going on here? Well, this had to do with their recent earnings report. The stock fell pretty big after the company missed their quarterly revenue estimates. And if we take a quick glance at this, we can see Q1 non-GAAP earnings per share of $7.88 was actually a pretty nice beat of around 67 cents. But revenue was a miss by about $3.33 billion. It came in at about $79.3 billion. The market didn't like this, so the stock sold off pretty heavily. Now let's look at them from a dividend perspective. Come up here and plug in MCK. And what we'll see is, yes, this is a low yielding company. It's sitting at just 0.51%. But for certain types of dividend investors, this company may be a good fit. And let me show you what I mean. Now, first off, we can see double-digit dividend growth, which is definitely something you want to see if you're looking at a lower yielding stock. But the payout ratios are also very, very low. Look at this, payout ratio just 8.2% and free cash flow payout ratio just 6.35%. So really, this company is using very little of their capital to pay out dividends, and this is very evident when we look at the free cash flow versus dividends being paid out. 2023 free cash flow was about $4.6 billion, while the dividends they paid out was only $292 million. So this company could easily massively increase the amount they pay out in dividends in the coming years if they should choose to do so. And keep in mind, like we just saw, they actually are doing this. We already saw a 15% dividend increase. So there's probably a lot more dividend growth on the way from this company. If we jump over to our stock screener and plug in the stock ticker, and what you're going to see is the exact reason the company's been able to increase their dividend payments at such a high rate. Look at the top line growth, revenue per share, going from $521 per share all the way up to $1,961, and look at how consistently the free cash flow per share has grown over the past decade. This is exactly what I want to see from the holdings in my portfolio. Now keep in mind, like we saw, they're actually using very little of their free cash flow to pay out dividends. So how else are they using their capital? Well, one of the things we can see is they've also rapidly bought back shares over the past decade, and especially in the past 5 years. They've gone from around 235 million shares outstanding to just 141 million. So remember, buying back shares increases all of the other per share metrics. It boosts things like earnings per share, revenue per share, and free cash flow per share, and actually helps the company pay out even more in dividend payments. So with this company, no, you're not going to get big dividend payments immediately, but this could be a long-term dividend growth play if you're someone looking for very safe, stable, and growing dividend payments. So there you go, those are 5 different dividend stocks that just recently increased their dividend payments. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.